When we look at the multi-billion-dollar empires dominating our world today, it's easy to assume they were always giants. Look closer at their histories, and you'll find some of the most recognized brands on Earth started selling ice cream from a renovated gas station. This is the exposed circuit board of the Apple I. Before they had massive corporate campuses, tech companies hand-built rudimentary hardware like this inside suburban homes. A great idea is a necessary starting point, but it cannot survive on its own. Every business needs fuel to grow, expand, and eventually capture a market. In the business world, that fuel is financing. Take Alex, for example. She makes the most popular neighborhood chocolate chip cookies, and she has a clear goal. She wants to turn this weekend hobby into a massive commercial bakery. To get there, she has to find the right kind of fuel. The choices she makes right now about where to get that money will dictate how fast she can grow, how much personal risk she takes on, and how much of her own company she gets to keep. Right now, Alex faces her very first hurdle. To bake enough cookies to meet her daily demand, she needs $500 to buy a commercial-grade mixer. To cover this first cost, Alex can fund the business herself using her personal savings, income from another job, or assets she already owns. The primary advantage of self-funding is total control. Since it's entirely her money, she retains 100% ownership of the bakery and makes every decision on her own. However, her available capital is strictly limited to what she has in the bank. If the business struggles, she takes on a high degree of personal financial risk. To cover early expenses like packaging, she might turn to friends and family. This can offer much more flexible repayment terms, though mixing borrowed money with relatives can make Thanksgiving dinner awkward if the terms aren't clear. Starting out by self-funding is the safest way to protect your control over the business, but relying strictly on the cash you have on hand is also the slowest vehicle for growth. Fast forward a bit, Alex's cookies are officially a local hit, and it's time to open a physical storefront. But to secure a retail lease and buy industrial ovens, she needs $50,000. For larger amounts of capital, most entrepreneurs turn to traditional bank loans, which means the business is now carrying debt that must be repaid with interest. Banks don't hand over cash based on a good recipe. They evaluate her credit history, her current cash flow, and her overall capacity to pay them back. By taking a loan, Alex still owns the entire bakery, but she carries a fixed monthly repayment obligation. She pays that bill every month, regardless of daily sales. There are also alternative lenders online that provide emergency cash much faster than a traditional bank, but those options almost always come with much higher costs and tighter repayment windows. Using debt accelerates your physical expansion while keeping your ownership intact, as long as the business generates enough consistent cash to survive the heavy pressure of mandatory monthly bills. Jump ahead another 5 years. Alex now wants her brand in every national grocery store. To build the required factories and distribution networks, she needs $5 million. At this massive scale, traditional bank loans become too risky for most banks to approve. This is when companies look toward investors and venture capital. Venture capitalists provide millions in funding, plus vital industry expertise to rapidly scale. By trading a slice of the company, Alex avoids loan repayments. However, she permanently gives up a portion of profits and shares her decision-making power with new partners. Alternatively, she could explore routes like crowdfunding, allowing her to raise that capital by gathering small contributions from thousands of online fans instead of a single firm. Giving up a piece of the business is a major compromise. You are surrendering absolute control over the company you built in exchange for explosive, debt-free growth potential. Looking at Alex's journey from a single oven to a national brand, it's clear that no single method of financing is perfect for everyone. The right tool changes based on the current stage of the company. Before raising money, every entrepreneur has to ask themselves, how much cash do I actually need? How fast do I need it? Can I comfortably afford fixed monthly payments? And am I willing to share ownership? Every massive corporation you see today originated from a single entrepreneur evaluating these exact same trade-offs and finally taking action. Understanding these funding options is your blueprint for supporting long-term growth. Figure out what your business needs today, choose the right fuel, and start building. Thanks for watching, and we'll see you in the next video.